please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me are Sonia and Anuj. Well, we have at least some green on the screen. We have had some debilitating last 3 or 4 days, and this entire narrative of buy on every dip has been wiped out for now. So it's whatever we saw yesterday was perhaps a very tired kind of recovery, a very unreliable kind of recovery. But nevertheless, let's take it with both hands. There is green on the Asian screen ahead of the Fed announcements. And we saw yesterday, of course, at least 10,100 acting as a bit of a springboard, and the markets going ahead, or at least the Nifty springing up. We will have to see. Customarily, as Anuj has always been pointing out, ahead of the Fed, the markets tend to be on the front foot because the Fed put has normally worked. But we have a new Fed chairman, so this time the markets perhaps will be a little more cautious. Morning, both of you.
Hi, good morning, Lata. Good morning, Anuj. That's the question, right? I mean, even the recovery, whatever recovery we've seen is so feeble, it gets sold into. So the question is, will we see any conclusive short covering bounce, or will it just amble within this zone? Anuj, morning. Yesterday, we did see a lot of selling in the F&O market. There was almost more than 2,000 crores of selling in the F&O market. Do you get a sense that this 200-day moving average could prove to be a bit of a resistance in the near term?
Morning, Sonia. You literally snatched the words out of my mouth. It's a feeble market. The rally yesterday was very feeble. The texture has become weak for this market, and of course, you don't need me to tell you that. There's no major selling in cash market, and that's a bit of a good news for the bulls, because if you see the last couple of days, the market could have easily ended at low point, but market chose not to do that. That is telling you that it might just be biding time, but the texture is that rallies would be sold into. In index futures, again, FIs unbound about 8,000 longs and added about 9,000 shorts, 10,000 shorts nearly. And the long exposure of FIIs is now down to 43%. So that means there are 57% net short on this market. That means there are a lot of shorts in the system. And there is a risk, if you are a bear, of a possible short covering bounce. Anecdotally, markets bottom out when the longs fall to 35 to 40%. Now, it's not necessary that the markets respect that. It could be that the markets respect that. It could go lower. But the short point here is that the risk reward does not favor you to short below, say, 10,100, say like yesterday's low, because obviously 10,000 is going to be huge support. So what you're doing right now is if you're shorting around 10,100, your risk reward is not in your favor. Possibly if the market makes a move towards 10,180, 10,200, that's now going to be the new resistance for this market. At that point, if it's not sustaining, then perhaps maybe traders, strong bears would try a short trade. Even yesterday, the high was 10,155. The rising 200-day moving average is 10,166. So obviously now 200-day moving average will act as resistance instead of support that it was doing. The good point for the market, though, is that again, as we've been pointing out ad nauseum, there's at least one sector which is in a bull market of its own. That's the IT sector. Yesterday also, and in fact, if it wasn't for that big block deal on TCS that day, IT index would have been far higher. That sort of soured sentiment a bit on TCS. Otherwise, stocks like Infosys, HCL Tech, NIT Tech, all these stocks have done reasonably well. Bank Nifty is the weakest, and that process of financials weight coming down in the index and that sharp overweight coming down is well and truly on. But the sense I'm getting is that with global cues also looking slightly positive this morning, and the fact that you normally go into the Fed event with long positions, the risk reward may not favor you taking fresh shots. Of course, I could be wrong, but let's see how the markets move from here.
For what it is worth, there was a 350 crore buy from the FIIs in the cash market and a 750 crore buy from DIIs in the cash market.
Okay. All right. Let's kickstart the show on that note, right? Let's tell you what our wise experts have to say as we head into trade this morning. We have Sean Darby of Jefferies, who says that the US dollar is indifferent to what is happening, and so too is the long end of the yield curve. Sean adds that although positioning on the dollar has mean reverted, there has been little bid for the greenback despite ongoing trade negotiations and a revolving door of White House officials. Equally, the 10-year US Treasury has failed to break through 3% convincingly, helping equity valuations. The bottom line, he says, is that both US corporates and investors have shown a willingness to buy equities and pertinently US shares on the dip. With the greenback strangely subdued, the current environment has also allowed emerging markets to flourish. MSCI All World has been able to bounce back. Sean adds that Jefferies continues to be modestly bearish on India.
Okay, everything sounded bullish except that laugh. And suddenly you get that last statement. Yes, we have decoupled and we have underperformed. So even if you have 10 arguments why global equities will do well, we cannot be as cheerful as perhaps some of the other countries. Money market views now. Pramit Brahmabhatta of Veracity says in anticipation of the Fed rate hike, the dollar is trading stronger, which will put pressure on the rupee. Expects the spot USD INR to trade in a range of 65 to 65.50. That's another minor leg up for the IT index.
Okay, and Dhaval Dalal of Edelweiss says after the recent rally, bond market participants are awaiting the outcome of the FOMC meeting and prospective increase in FII limits, along with the auction calendar for the first half. He expects the 10-year benchmark bond yield to remain range-bound between 7.65 to 7.70% in the near term.
Okay, this morning I read an interesting edit. Forget about Aadhaar. The real threat is Facebook, and that's what's playing out, of course, in US market as well. Here's Nigel with the world view.
Well, the U.S. markets, they ended in the green in yesterday's trading session. All the three frontliners, they did quite well. If you're looking at stocks that were gaining on the Dow itself, well, Boeing was a stock that did considerably well. That was up close to 2%. And we saw a bit of a bounce on both Netflix as well as Amazon. Well, Facebook, as Anuj said, that one continues to get a bit of a whack. Cambridge Analytica disaster fallout, that continues to plague the stock. The stock was down 2.5%. I'll tell you what. Mark Zuckerberg, in fact, has sold nearly around 4 million shares in the last year or so. So he's been saved because in the last couple of days, the stock has lost nearly around 8%. But it's not just Facebook, mind you. From, the entire space, from the social media space, Twitter yesterday was down nearly around 10%. Israeli government is considering legal action against the company because, in fact, they refused to remove some content that the Israeli government had requested for. So all's not well in the social media space. Well, all eyes are going to be on the Fed meet. What's going to be the outcome? The bond yields yesterday moved to around 2.9% or thereabouts. Remember, 25 basis rate hike is what the street is working with. Commentary from the Fed, though, is going to be tracked very, very closely. If you're looking at the European markets, they ended in the green yesterday. All three of them ended in the green. The FTSE was a relative underperformer, ended with a gain of only around 0.3%. But crude oil prices did bounce back yesterday. They're trading at near 3-week highs. And if you take a look at the emerging markets, then the Brazilian as well as the Russian index, both of them gave you good returns. Well, Japanese markets are closed today, but the other markets that are opened, they're showing you a green tick. The Hang Seng, in fact, is up close to around 1%. And that would mean we would start off at least with some green for the SGX Nifty.
Yes, it's 9.5 points. Nigel, thank you very much for that summary. Fortunately, we don't have social media related stocks, but yes, just last week, Mangalam was pointing out that even advertisements by P&G and HUL on social media are beginning to decline. One, because Facebook is seen as uncool by the young generation. Too many aunties and grandmas are using it. And then there is, of course, the hate troll attached to Twitter. So advertisements are anyway beginning to decline. Well, we're more worried about the day ahead rather than what's gone, because there is the Fed decision in about 12 to 15 hours. And we have James Glassman, the senior economist, JP Morgan, joining us on the phone line from New York to tell us what he would watch out for. Good evening, James. Thank you very much for staying up for us. Well, what all would you watch out for? Yes, I believe 94.4% of the Fed Fund futures market is indicating a rate hike. But what else should one watch?
You know, I'm not really holding my breath for this. There's no reason for the Federal Reserve to surprise anybody. The market is expecting it. I think what's more interesting is for some time the market has been skeptical of the Fed's own view that they were going to eventually push the Fed funds rate up to roughly 3%. But I think in the last several months, the market is pretty much aligned with the Fed view. So what that tells you is the futures market has already got most of the Fed story in it. So if the Fed just continues to move slowly at a gradual pace, 2, 3, 4 times a year, it will take a couple of years for them to get up to that 3% level. It should be anticlimactic. And so frankly, you know, everybody is focused on the dots. Will they change? Honestly, these dots change all the time, and there are a number of people. I don't really think it tells you that much about what's coming. The Fed has made it pretty clear there's, you know, slow path of moving rates back to something normal. So I think it's much more important personally, I think it's the confusion about the uncertainty about this trade tension between the U.S. and China that I think has got the markets a little bit on their back foot.
In fact, that was my next question, James. Because of the possibility of a trade war escalating, do you think there could be more downsides to global markets, especially the U.S. market?
I think not, because I think the possibility of a trade war is not likely. It's not in anyone's interest. And the truth is, even when it comes to tariffs on China, there are many more businesses that are being hurt by that, and you hear from them. And so I think it's going to be, I think this is going to be more of a political story than an economic story. And I think the market, you know, on days when you hear something like this, the market's down, and then the next day you're back, and the market, I think basically the market believes it's not likely to turn into a trade war. That would be bad news for everybody. And if you got an administration that's focused on trying to get the economy to do better, it doesn't make sense, really. So I think trade war is not really the most likely outcome.
Okay, James, morning. What about a market like India, which has underperformed so much this year? Do you reckon it's a sharp bull market correction, or is there a bit of a bear phase in India right now?
I don't really know. I haven't watched it that closely to know what's going on. But I think the longer-term story is quite positive. I don't know why we're in a bearish mode right now. I don't know if it's what's happening in the developed economies or it's more unique to India. But I think longer-term, the story is still very constructive for India.
Okay. So at the moment, just to come back to the older narrative of the Fed, we just had a statement from Sean Darby of Jefferies telling us that the dollar index is simply not rising above 90. It's just not strengthening, and the longer term yields, the 10-year yields, are not rising above 2.9. That's the worst they went to. They're not getting even anywhere near 3. So you would say that the risk rally continues, both even in EMs, because the dollar is weak.
I think so. The long-term interest rate it's very interesting because the popular view is that interest rates should be going up in the U.S., but I think the fact that they aren't, all the reasons why interest rates should go up, long-term interest rates, we've known about this for a long time, and I think what it tells you, it's a more complicated story. For one thing, if the U.S. economy is bouncing back, the trade deficit's going to widen. That means countries that are generating surpluses need to hold the dollars. There are other reasons why bond yields don't seem likely to be shooting up. So I think if the dollar index is not doing better, as it hasn't, I think the story really is more about what's happening in the other developed economies. Sure. The outlook has improved quite a bit in Europe.
Sure. Okay, James.
That's the story.
All right, we'll leave it at that. Thanks so much for joining us. So that's the word coming in from JP Morgan. No surprises expected from the Fed meet this time around, despite a new chairperson. We'll take a break on that note. When we come back, we will talk to our research analyst about CNBC TV18's top 10 list of stocks to watch for the day. Hi, welcome back to Bazaar Morning Call. This morning, the Asian markets are trading slightly cautious. There is an expected Fed rate hike, remember. So ahead of that, the markets are flat with a bit of a positive bias, you'd have to say. In fact, now they are picking up. So Hang Seng has now picked up quite a bit. It's at the high point, up almost 400 points right now. And the Chinese market also looking pretty good. Our research team is here to give you the list of top 10 stocks to watch as we head into trade this morning. So let's welcome them. Anuj, what are you looking at?
So, Sonia, with the caveat that in the past, we have not really kept pace with the Hang Seng market, but because we are net short, today could be a day of rally, actually. And in that, you have to choose stocks on the upside. I think I want to give a bit of time to a stock called BEML because yesterday it looked really interesting to me. Yesterday, it went into triple digits and then had a rally. So what happened yesterday was that it fell below the start of the divestment rally. So what the market did yesterday was they completely priced out divestment. And now the stock is out of F&O ban. So obviously there was some big short covering yesterday. But it's now trading not only below the divestment price, but also below its median valuation. So even if you take divestment out of the equation, even then, the stocks saw big risk reward, and that's why there was a bit of a rally. The disinvestment process will happen. It will take time, of course, but it may pick up post the Karnataka polls. And in that, what is really interesting is that the preliminary surveys are indicating that BJP has an edge over Congress in the Karnataka polls. And if that is the case, then once the elections are over, this disinvestment will go through. And you have, of course, players like L&T, Bharat Forge, all in line for this one. So that I think really would be the stock to watch out for me, considering that it's fallen so much. The other one is, of course, a all-weather stock, Ashok Leyland, rallied sharply from 20-day moving average yesterday, within 3% of fresh lifetime high, and there was strong delivery buying yesterday. From the low point, there was decent recovery in Ashok Leyland.
Okay, that makes sense to take a logical bet on BEML, but it's only logical. Remember, we are not privy to any information. Well, Nigel, clearly JSPL in the news, they're going to raise money through a QIP.
And that's right, Lata. In fact, yesterday, towards the end of trade, the street was sensing that a QIP has been launched. It's been launched at a price of around 227. That's at around a 2.5% discount to yesterday's close price. Remember, the stock has corrected nearly around 20% from the peak that we saw. Now, they're likely to raise nearly around 1,000 to around 1,500 crores. This money will be used for working capital and payment of creditors and the likes. Remember, they're sitting on a huge debt of around 46,000 crores. But we're going with green today because the overnight feedback is that, in fact, the response has been strong. And secondly, Macquarie as well has written a note that steel demand on the ground is very, very strong. So expect that stock. Yesterday it was up 4%. Today as well expected to do well.
Oh yes, up 6% yesterday. So could be an interesting mover today, GSPL. Thanks, Nigel, for that. Mangalam, what about Greenply?
Well, yesterday, Anuj, the board met and they have given a nod to explore the demerger of one of their units, which is the MDF unit. Why is this important for the company? Because, well, in the larger scheme of things, the MDF business, while it accounts for just a third of their revenues, close to 370 crores in terms of revenues, it accounts for more than 50% of the company's operating profit. So demerger perhaps would be a move towards unlocking value. But the big question is how much value will be unlocked and how much of it is in the price? Because the stock has doubled in the last 2 years, primarily on account of this MDF play. And secondly, the stock has moved almost 50% from October levels as well. So a large part of it is in the price. What is not in the price, however, is that when there is a merger, we talk about synergy benefits. When there is a demerger, could the synergy benefits wane away? And in a market like this, maybe the stock could see some bit of red.
Okay, that's important. 1/3 of the business getting demerged. So that's something that the street is going to look at very carefully. But more order wins coming in. Ashoka Buildcon is on our radar. Sonal, tell us more.
Well, it's raining orders for Ashoka Buildcon, and yesterday the company informed the exchanges that it has received 2 orders for upgradation of 2 projects, and the total cost of the project is around 447 crores. Remember, in March itself, it has received about 2 to 3 orders amounting to a total of 5,500 crores, and I expect the stock to be in green today.
All right, thank you very much for that, Sonal. But one element that will go perhaps against several stocks would be the rise in crude prices. Manisha?
Oh, well, yes, and 2% gains overnight, and we are seeing some more strength come back for the crude oil prices. So it's inching towards 64 for the US crude, and 68 is almost there for the Brent prices. It has been quite some strength overnight and in Asia right now. Well, the API suggests that you could see a drawdown in the US weekly inventories. That has been supportive because for the last many weeks, we have seen build-ups in US inventory, their exports and their production as well. Add to that the fact that you also have seen Middle East tensions come back, so that premium is building on, and then there is decline in Venezuela output as well, and that seems to be supporting the markets. But having said that, it really is going to be about the US Fed statement tonight that the markets would react to. But on the charts, this does look better slightly now.
All right, thanks a lot for that. We're going to watch out for all these stocks, right, that get impacted because of higher crude. There's your aviation stocks, your tire stocks, etc. But a quick recap now. Stocks expected to gain today are names like BEML, Ashok Leyland, JSPL and Ashoka Buildcon. While stocks that could be under pressure, Greenply, BPCL, HPCL, IOC, all the crude impacts, Jet Airways, SpiceJet, Interglobe Aviation and Asian Paints. But we're also going to watch out for the pharmaceutical space. Sun Pharma is in focus this morning. Ekta is here to tell us why. Ekta?
Well, the reason why I'm going to be looking out for Sun Pharmaceuticals for the rest of March is basically the approval or the target action date, which is when by when the US FDA will have to take a call on one of their specialty drugs in their pipeline, which is MK-3222 or Tildrakizumab, which is being studied for psoriasis. Now, why exactly is this important? Is that this would be a novel drug, which if in case it does get approved by the US FDA, Sun Pharma will be marketing it as its own branded product in the US, and hence there will be no sort of generic competition. It would be a biologic equivalent in the US for psoriasis. Now, the important thing to note is that this particular drug, the potential market size for this particular drug is around $5 to $6 billion, and the market itself is growing in terms of mid-teens for this particular product. It is already a competitive space. It has around 6 to 7 drugs in the market in the biologic space which is already selling this drug. The biggest drug in the market is Humira, which is basically used in terms of multiple dosages, as opposed to Tildra, which is actually expected to be a lower dosage drug, so and probably higher safety. Now the thing is that the street is divided in terms of how important this drug would be in terms of sales for Sun Pharmaceuticals. Remember, the psoriasis market is around $5 billion, growing in mid-teens in the US, but the peak sales can be estimated anywhere between $200 million to even $1 billion for Sun Pharmaceuticals.
Has anyone added to the EPS?
Not as yet, because the first year they're going to probably break even. The EPS addition will come year 2 onwards, and that too dependent on how much market share they gain. Yeah. So the EPS addition could be around 5 to 6 rupees, and assuming $400 million in terms of peak sales for Sun Pharma. It is important to note that this would be a venture into the specialty product pipeline for Sun. So despite it not probably achieving higher sales, the milestone would be important for Sun Pharma.
Okay, Ekta, thanks a lot for that. So we're going to watch out for Sun Pharma as well as all the other stocks that we just spoke about. But in the meantime, let's also get you some market opinion. Here's a big CNBC TV18 exclusive. Nimesh and I caught up with Sakti Siva, the Managing Director and Head Asia Pacific and Emerging Market Strategy at Credit Suisse. Began by asking her rationale behind the underweight call on India. It continues to be an underweight, by the way, but she also says that she'll be looking or advising clients to buy India on every big dip. Listen in.
We're still underweight at this point in time. I mean, the reason for being underweight, as you know, are firstly valuations and secondly earnings revisions. So on valuations, India has been in what we call the expensive 4 club, which is the 4 most overvalued markets in the region. The premium has been above 50%. So yes, as you correctly point out, India so far this year is now the 2nd worst performing market, and as a result the valuation premium has actually come below 50%. So we are looking at India, but it's still in our expensive 4. So I guess my answer to your question is, while the valuations have improved, at this point probably not enough for us to upgrade our recommendation. The second reason for the underweight is actually earnings revisions, which are very poor. India has had almost 3 to 4 years, consecutive years of earnings downgrades, whereas the rest of the region has seen certainly quite strong earnings upgrades last year, and even this year the revisions are flat. So India is still trailing the other markets in terms of earnings revisions.
Hi Shakti. So, given that you had a valuation concerns for India for a very long time, now that the markets have corrected, the expectation is that the earnings are going to pick up. How much more downside do you see for Indian equities, which will make you comfortable from a valuation perspective?
From a valuation perspective, as I said, for us, we tend to make a strong underweight call when the premium is over 50%, and the premium for India went above 50%, I think, about 2 years ago. In August of 2015, so we have been underweight for quite a long time. But it's not always that we are underweight. I do like to remind you that after taper in 2013 in June, India actually joined our cheapest 4, and we were actually overweight India all the way from 2013 till August of 2015. So it's not so much absolute downside that we are talking about for India, it's more relative. So we think that while the premium has come below 50, we would like to see it come down a bit more. So we would like to see probably another 5% underperformance relative to the other regional markets before we consider an upgrade of India.
Okay. Apart from valuations and earnings revisions that you spoke about, there are other issues that India has been plagued with as well. One, of course, is the banking-related scams. The other is the political turmoil and the evolving story there. How worried would you be about these issues, and do you think they could take India down further?
I mean, those issues are also there, but for us, the 2 factors that we focus on, particularly, as I said, in a regional context, valuations and earnings revisions. I mean, with the BJP, yes, I mean, the last by-election, the fact that the opposition parties are starting to band it together, and maybe if that slows the pace of reform, that is an additional concern. But at this point, as I said, our bigger concern is the valuations and, as I said, the earnings revisions. I mean, India has trailed regional markets on earnings revisions for now 3 to 4 years. So there was always an excuse, it was demonetization or GST. But to be frank, India's earnings downgrades preceded these two episodes. Now, obviously, the banking sector thing has also contributed, but that also hopefully will get sorted out soon.
Shakti, you track the flows very closely, and while the FIs have net sellers across Asia since the beginning of this year, still we haven't seen a capitulation, so to speak. You talked to a lot of investors at the conference. What is the sense that you pick up? Are the investors now worried about any signs of capitulation for emerging market and Asian equities in the first half of this year?
Okay, that's a good question. Actually, that's something that we track a lot. So the good news is on a rolling 12 months, we define capitulation as foreigners being net sellers on a rolling 12 months. At the moment, that number is now 0. So we have not yet gotten to negative. So we will also get more excited both about India as well as the region if that number goes negative. The last time we had foreign investor capitulation was actually 2 years ago in January of 2016, and we made a big buy call at that time. At this point, as I said, we are still at 0, but if we do get a bit more foreign selling, we actually would officially be in capitulation territory. Now, some markets are already in capitulation territory, markets like Taiwan, even Japan. India is still on a rolling 12 months basis, still at a positive number at this point.
Shakti, while FIs are still positive on Indian equities, the bigger strength for the equity markets locally has been the domestic flows. You talk to a lot of our Indian counterparts as well. Any sense of the domestic liquidity can dry up a little bit if there is a sharper correction for Indian equities in 2018?
I'm not sure whether the domestic flows dry up. In fact, I think one of the reasons why India did well last year, despite quite a lot of earnings misses, I think was the domestic flows. I mean, you have also got other markets like Thailand as well, where the domestic flows have helped to support these markets. But our view is that it is normally the foreign investor that drives the overall trend. So we would again be happier to upgrade India. If and when we see foreign investor capitulation, if and when India's premium comes down further, and if and when earnings revisions start getting less negative. There were a couple of months in November, December, where India's earnings revisions turned positive, but they've once again turned negative so far this year.
Okay. What is your sectoral view now, Sakti? Because, a couple of years ago, you were very positive on metals, and we saw a huge rally in names like Hindalco since then. Of course, at the start of this year, these stocks have come off a bit. But how are you positioned in terms of sectors now in India?
Actually, our positioning, has not changed much. So we like IT as well as metals, so more in the cyclical sector. So we do like HCL Tech on the IT space, and actually we still also continue to like Hindalco. On the materials space, it wasn't so much an argument about demand. It was more an argument that we are starting to see supply cuts, and that may help to prolong the commodity cycle.